Hello, friends. Last week, I told you that the market would need to watch these five triggers. Once you get a tick mark, a bull run would commence. And I followed it up with a fortnight ago saying that the markets would very soon hit a new all time high. Well, it partly came true because the Nifty managed to close at an all time high, although the absolute all time high on an intraday basis still remains to be scaled. What is the outlook going forward? This video is all about that. Let's dive right in, and on your screen right now is a market roundup window which tells you that the rally was powered more by banking because the bank nifty rose more than the nifty 15 percentage terms. The US dollar index was to thank for it. It basically fell 91 basis points, and a weak dollar is always good for emerging markets, including India. And a weak dollar triggered some kind of buying in silver, though gold fell. And crude oil fell in spite of a weak dollar, which tells you that there is an inherent weakness in crude oil. It's something that I have been telling you on my social media accounts for more than a year and a half now, that there is no super cycle in commodities. It's a bull market, not a super cycle. Natural gas continued to go up due to winter considerations, and I've written a fairly detailed editorial in my Telegram channel. Do make a note of that, please, in the last week or so. The 10-year benchmark bond yields also fell 2 basis points, which means bond prices went up, which is what cheered the bank nifty. NSE gained market capitalization to the extent of 0.83%. I wish it was higher, but it's not. So there is still a small sense of foreboding or a little bit of caution in the undertone. The MWPL fell along expected lines due to expiry, and the US markets provided tailwinds to the Indian markets. On your screen right now is the daily chart of the US Dow Jones Industrial Average, which, even though is still in a death cross technically because the 50-day moving average is below the 200-day average, but it's climbing very, very rapidly. And there is a possibility that you could actually see the reverse of a death cross, which is the golden cross, when the 50-day average crosses the 200-day average upwards. The last mile resistance on the Dow was at 34,281, which the Dow has managed to clear, but it needs to trade above this level for a few trading sessions to imbibe more buying confidence. So one positive aspect is the Dow. Let's see the Nasdaq 100, the index that is directly responsible for influencing Indian technology stocks. It's above its 50-day moving average, but relatively speaking, compared to the Dow, this chart seems a little relatively a little weaker, which is what explains to you why the Indian tech stocks aren't really moving too well. So we still have a couple of resistance levels to cross. First of all, this index must remain above 11,682, then go past the 12,898, and then past the 13,721 before a cheerful bull run could begin. So let's wait and watch. The broadest of these indices is the S&P 500, which again has witnessed a death cross. The 50-day moving average is going up. The price is in a kissing distance above its 200-day moving average. What we do need to see is whether the S&P 500 manages to cross and stay above the 4,119 level. So relatively speaking, the S&P 500 is better as a chart formation compared to the Nasdaq 100. Returning back to our in-house indicators, the MWPL has fallen on a week-on-week basis. It's purely due to expiry considerations, but the fall to 22.93 is still, the level is still higher than the previous expiry where it went to 21.28. And do remember that in the run-up to the expiry of November, we've seen a high of 32.93, which is higher than previous expiry at 29. So risk appetite has definitely improved, and therefore the bulls have a chance of pushing the Nifty 50 up above the all-time high. Let's take a look at the index and stock futures turnover. This is cumulative 3 series, so December, Jan, Feb. The stock and index futures turnover both rose, although it was clearly the stock futures turnover that stole the limelight because risk appetite was back. So bulls are taking bigger bites with their buying in the markets. Now for the advanced decline ratio, friends, this ratio has climbed past above the 1.0 level, which is where it should be if at all the market is to sustain on the upside. Now, 1:1 is when buyers, the losers and gainers are equal. And what we need is that the gaining stocks need to be higher than the losing stocks, and the Nifty should continue to rise. That is when a robust and a sustainable upthrust will occur. Coming to the basis, which is the futures premium or discount to cash, what we are seeing is highest basis in the chart period here. And what we are seeing is short covering and extreme amount of optimism, which has triggered this kind of a basis. Frankly, I don't really believe that this large basis is sustainable. You're likely to see erosion, A, due to profit taking at higher levels, B, and more importantly, because of the time tenure remaining to expiry. As the derivative series progresses, as expiry approaches, normally premium does trend to contract. So gravity will see the call on the basis, which is one reason why you will see a little bit of a decline in the Nifty. It may not actually be an absolute fall. It could be erosion of the premium itself. So be careful about that. Don't mistake it for bearishness. Now I come to the impetus chart, which basically again indicates a dichotomy. The reason why I say dichotomy is because the bank Nifty impetus is showing signs of weakness, whereas the Nifty impetus has risen on a week-on-week basis. Do remember that the bank Nifty saw a clear decline on Friday. And it was weak even on the opening session of the week on Monday. So the force, the momentum of buying that we do need on the bank Nifty was a little wanting, which is why the impetus reading is down. What we want is both the indices, and I've written in my live mint column many a times, these two indices are like the tires of a bicycle. For the bicycle to move forward, both the tires must be inflated and filled with air. If one of them is punctured, the market slows down or even comes to a grinding halt or even goes backwards, which means fall. So what we need is the impetus reading on both these indices to rise together with the price. Now for the LWTD indicator, which has been proving itself for almost 3 quarters now. What we are seeing is the bank Nifty percentage gain loss line has gone up above zero, and the LWTD has risen in tandem with it. So what it means is that compared to the prior week, last week saw increased amount of buying support on declines on a weekly basis. This is a chart which I update on my social media accounts every day. So do connect with me. My contact coordinates come at the fag end of this video, also in the description and pinned comments below. So stay abreast with what's happening in the market by updating yourself in real time. Now for the footprint of the four market participants, starting with the FIIs, who've increased their net long positions in both index and stock futures. No questions about it. These guys seem to be gung-ho. Now, where DIIs or domestic investment institutions are concerned, they've increased their net short positions in stock futures and cut their net short positions in index futures. So that's more of a trade-off. The reason why DIIs tend to be short in index and stock futures is because they buy in the spot market and they hedge their purchases by going short in futures. So these positions of the FIIs need not be taken as a standalone bearish or bullish indicator. Coming to the footprint of the prop traders, very sharp guys. Brokers own proprietary trades. They know who's buying and selling, so they are second best to insiders. What we are seeing is that they've cut their index net short positions almost to half, and they've raised their individual stock futures long positions mildly. So the prop traders are indicating that they feel the market still can go up higher. So yes, the bulls have the potential to take the Nifty to the all-time high and possibly past it as well. Now for the retail guys, these guys have been doing all the heavy lifting after COVID lockdowns were imposed. They've reduced their net long positions in both index and stock futures. So they seem to be encashing their chips and taking some profits home. Nothing wrong with that. Whenever the markets hit a new high or approach a new high, weaker hands do tend to bail out of positions and stocks go into stronger hands. So that churn is one thing that I would attribute the fall to. Now, friends, the four index heavyweights and what they are indicating to us, starting with the heaviest boy of them all, Reliance Industries, with a weightage of 11.03%. Reliance need to stay above the 2,618 levels all of the coming week and possibly go past the 2,677 levels. Do remember, with a weightage of 11.03%, it can swing the Nifty with it significantly. Price remains above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So near-term bulls are still in the money and not under any pressure to square up their long position. So positive for the Nifty. Second highest weighted stock in the Nifty is HDFC Bank, and the highest weighted stock in Bank Nifty. So Nifty weightage 8.26%, Bank Nifty weightage to 25.61%. Price has stayed comfortably above its 25-day exponential moving average, which itself is rising. And as long as the bulls are able to keep the HDFC Bank counter above the 1,550 odd levels, the day belongs to the bulls. So this stock can support both the Nifty and the Bank Nifty, and therefore assumes importance. The third counter out here where the weightage hierarchy is concerned is Infosys, third highest weightage in the Bank Nifty, in the Nifty 50, 7.06% weightage. Price is above its 25-day exponential moving average, which itself is going up. But what we do need to see is the price going above and remaining above the 1,728 levels. Early days yet, too premature to open a bottle of champagne right now. Let's see if the upthrust lasts. The last stock in the index heavyweight segment, this stock again, like HDFC Bank, is a constituent both of Nifty and Bank Nifty. As a matter of fact, this is the second heaviest weighted counter in the Bank Nifty at 24.62% after HDFC Bank. The price is above its 25-day exponential moving average, but Friday has seen a bearish piercing candle, and it's come down from the 940 odd region twice. Last time it happened was in early October, when it retraced its steps from there. So that area, 940, 945 odd area, is becoming a kind of a glass ceiling. Can the bulls take the price past this glass ceiling? Time will tell. But this stock remains positive as of now because it's above its 25-day exponential moving average, which is more or less at 910. Friends, I now come to the bond market, which saw bond yields falling by 2 basis points on a week-on-week basis, which means bond prices were up. Banks had a mark-to-market notional gain on their bond portfolios, which is what explains to you why the Bank Nifty was cheerful, relatively speaking, as compared to the Nifty 50. The 7.10 level, which I've talked to you in my earlier videos still remains on my radar as a level to watch. and since we didn't know whether the bond yields would peak out at 7.6 or 7.8 or 7.10 or maybe even higher, I suggested laddering to you, the advice that stood out in good stead. Would I ladder still? Yes, I would. So every time a round number is passed, I would continue to ladder. Now, friends, I come to the US dollar index, extremely critical for emerging markets, including India, because our imported goods, including crude oil and natural gas prices, which happen to be inflationary, are determined by the US dollar index. This index has fallen on 4 out of 5 trading sessions. Price remains comfortably below its 25-day exponential moving average, which itself is falling, which means the near-term outlook has turned cautious. Now, upsides are likely to run into resistance at 109.14, and your last mile support for now is at 104.51. That's the kind of range that you're likely to see on this currency index. Now, since the price has fallen on 4 out of 5 trading sessions, although Thursday and Friday saw a relatively muted fall, the fact remains that commodity prices, including bullion, might just receive a boost as long as the US dollar index remains weak. The weekly chart on your screen tells you the same story. A bearish candle which has tried to go past the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull, failed, and the price has closed towards the lower end of the weekly range. Here again, 104.51 is a level I would want to watch out for. Last week, I advocated a range between 109.42 on the upside and 104.52 on the downside, which held perfectly well. In the coming week, I estimate a range between 108.50 on the upside and 103.60 on the downside. Friends, the dollar index done, I now come to the Bank Nifty, which gained 1.29% on a week-on-week basis, rose on 3 out of 5 trading sessions. The only sign of concern, as you can see on the daily chart on your screen, is Friday's prominent bearish candle. Although it's not really a bearish engulfing pattern, but coming at all-time high, it's a marginal sign of concern. It could be weekend profit taking. We'll never know. So what we need to see is whether follow-up buying support is forthcoming. Price is comfortably above its 25-day exponential moving average, which in turn is rising. So as long as the bulls manage to keep the Bank Nifty trading above the 41,840 levels, all is okay. The weekly chart on your screen tells you the same story. 41,840 remains a level to watch. Price is comfortably and significantly above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook also remains positive. Now, friends, in the week before last, this index was at number 4 of our statistical beta or in-house volatility list. That's where it remained. So, number 4 for a big index like this is fairly challenging for a retail trader. So, do be careful out there. Last week, I advocated a range between 43,850 on the upside and 41,025 on the downside, which held perfectly well. In the coming week, I expect a range between 44,375 on the upside and 41,600 on the downside. Friends, I would still remain of the view that you should trade light and keep stop losses in place. Bank Nifty done. I now come to the Nifty 50, which gained 1.12% and rose on 4 out of 5 trading sessions. As you can see on the daily chart on your screen, the price has remained above the 18th Jan swing high at 18,351 level. So that leaves the October 2021 swing high to be the last mile resistance, which is at 18,604. Once you cross past that, I think the bears will cover their shorts and provide further fillip to the market. Price remains above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook remains positive for now, and the average itself is rising. Let's take a look at the weekly chart, which shows a bullish engulfing pattern. Price remains comfortably above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. The last mile resistance being 18,604. Take it past that and you have the bulls comfortably back in the driver's seat, back in command. Week before last, this index was at number 16 on the most volatile counters list, in-house statistical beta list. It rose 4 notches to number 12. Now that's not welcome. A heavy-weighted index like this rising in statistical beta would raise the challenge level for intraday traders and therefore provide ample amount of anxiety. Last week, I advocated a range between 18,800 on the upside and 17,825 on the downside, which held perfectly well. In the coming week, we are likely to see an estimated range between 19,000 round figure on the upside and 18,025 as a support on the downside. Here again, please keep your traded volumes low and stop losses in place. Friends, now for the last bit of charting, the retail risk appetite gauges as we see them from the percentage contribution, percentage contribution of stock and index futures and options turnover of the entire turnover of the week. The sky blue line is the stock options turnover, which has fallen on a week-on-week basis, and the olive green line is the stock futures turnover, which has remained more or less constant as compared to the week ago, even though the Nifty has risen. Look at the red line here. That shows signs of flatlining to attempting to rise. Now, this is the percentage contribution of the index futures turnover. Do remember that the indices have witnessed expiry on last Thursday, and therefore around expiry it is the indices which witness higher allocation of traders' resources because of lower span margins and lower mark-to-market threat perception. Index options turnover contribution, what we are seeing is that the peak made on Thursday, which it does usually because Thursday is the weekly index options expiry. So normally you'll see the index peaking on Thursday where contribution of the volume is concerned. And the last Thursday's peak was lower than the Thursday prior to that, which tells you that rather than index options, it was index futures, which you saw as a red line in the previous chart, which was receiving higher allocations. Friends, when traders play more in futures, it is a sign of higher risk appetite. Remember, it takes more amount of money to dabble in futures due to span margins. So there is no shortfall of risk appetite amongst the retail traders. So I would say that the probability of a new high is that much more better. Friends, I now come to the most popular segment of this video for statistically minded traders. I give you 5 stocks which gained the most amount of statistical beta and impetus on Friday. So you take a small exposure and wait for bigger price moves on Monday. And 5 stocks which lost the most amount of impetus on Friday. So you take a higher exposure and wait for smaller price moves on Monday. This list would benefit scalpers. Do note this list is valid only for Monday. Should you want to be updated about this list Tuesday through Friday, do connect with me on my Telegram channel or a request to be put up in a WhatsApp broadcast list, and we'll get you going for free. So the risk of impetus gainers, where you take small exposure, wait for large price moves, is led by REC Limited, number 2 HDFC Life, number 3 IOC, number 4 BPCL, and number 5 Canara Bank. Do notice one thing, most of them are PSUs. That's what was ruling the roost last week, PSU stocks. Impetus losers list is led by Sun TV, followed by Ramco Cements, number 3, Indian Hotels, number 4 Jindal Steel, and number 5 HDFC Bank. Now this list is subject to change on a day-on-day basis, so do connect with me to update yourself Tuesday through Friday. Friends, I now come to the fag end of this video. Humble request to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. I'd love to listen to your feedback as to how my videos are helping you become better at your trades. So please keep the comments coming and help me reach out to fellow like-minded traders like yourselves by sharing my video with your social media groups and your friends and family. Thanks for your patience in being with me in this video. Till we meet again in my next video. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Bye-bye.